basically you're going to have some sort of a gain or loss that's going to affect that equity account as well. And so that's normally when you're going to have a realized gain or realized loss on the sale of these securities. The other issue that we have to deal with is from the time at the point of acquisition and also certainly at the point of liquidation or sale, how do these things get reported in the financial statements? Now, recall, what are the basic financial statements that we're dealing with? I need a new color. Let's do, what color? Purple? Did I do purple? I don't think I did purple. Okay, so what are the financial statements? Right. Income statement, right? Balance sheet, statement of cash flows. These are the ones that we're mainly dealing with here. So the question is how do these things get recorded? Well, on the income statement, we're going to record a gain or loss certainly at the point we sell the investment, assuming there is a gain or loss, and that's going to go down under those other gains and losses. Maybe in the middle here, depending upon what it is, unrealized gains and losses might get recorded there too, but that's where it gets kind of tricky because I don't know if you remember in Madrid where we talked about the clean surplus versus dirty surplus model. A clean surplus model is one where anything that affects retained earnings, anything that affects the equity account pertaining to revenues and expenses and gains and losses, all right? Anything that goes, that appears in here went on the income statement. So in other words, there's nothing that goes into the retained earnings column here. Remember, okay, here's a common stock, here's the two main accounts, and here's retained earnings, all right? Invested capital, investors, retained earnings, revenue, expenses, gains, losses. So it doesn't go here unless it was on the income statement. That's the clean surplus model. So you can't sort of bury something in retained earnings unless it went through the income statement. But the dirty surplus model allows us to run some things into retained earnings that never went into the income statement. In other words, revenues and expenses or gains and losses. And as it turns out, investments has sort of led us to the point of allowing some dirty surplus accounting, some stuff that might go into the equity section of the balance sheet without ever hitting the income statement. So that creates some interpretation problems for us sometimes. So we have the balance sheet, we have the income statement. On the balance sheet, the main issue is this. Are we going to categorize these investments as a short-term investment, a current investment, or non-current, long-term? And basically, if it involves the investment of funds just on a temporary short-term basis, we'll consider them to be current assets. But normally, strategic investments, which may be held for a number of years, are treated as non-current investments. Statement of cash flows. Let's see. Remember, the statement of cash flows is divided into three parts, right? So the statement of cash flows tells us what? It tells us what happened to our cash flows. And so we could have cash flows from our operations, right? Which is basically the cash flows related to our revenues and expenses from our core business operations. We could have investing cash flows, and we could have financing cash flows. Remember that investing cash flows are normally acquisitions or sales of plant, property, and equipment, as well as investments. And so our investments, we use some of our cash to buy investments. That is going to be shown as a cash outflow under investments. And when we sell our investments, there's going to be a cash inflow from investments. All right? And financing, of course, you remember that's related to issuing stock or buying back our own stock, not other company stock, our stock, or issuing debt, borrowing money, or repaying what we owe. So this is sort of an overview of what we're going to be looking at here, and I'm going to finish this module now, and we will go on and take a look at some of the valuation issues that we're facing today in the real economy in the United States, particularly the United States and Western Europe. On to section 2.